Guys, welcome to the Savvy Man Show with me, your host Sean. If you find any of today's entertainment helpful, don't forget to smash that lovely like button. If you haven't subscribed already, don't forget to hit that subscribe button, bell notification. You'll be notified when a new video comes out. Thank you to everyone who has subscribed. You've been amazing. Thank you to everyone who has given up your precious time to watch this video. I know you could have chosen anyone to watch. If you're looking for a free trading platform which to trade your stocks and shares, don't forget to check out the links in the description below. You get a free share up to £200 for signing up and depositing a small amount. Free trade just needs a £1 deposit, so it's free money. The others require a £100 deposit. Now on with the show. We're opening up my portfolio. Now this one I originally got before doing a dive into it. It was cheap. I was putting, whenever I'd done a trade, leftover pennies was going into this. PE ratio under a 2, dividend ratio of 2.2%, profit margin of 9. Now the debt to assets have gone up. This was 70% because of what's happened this year. That's why it's increased, but they've been working throughout coronavirus. Now I swing traded this. I made over 50 quid on that. I moved the 50 quid over. I had a few quid left over. I don't think it's gonna go back up that much, but they are still operating. They have been operating. If they go up to the heights, I'll sell. If I get a profit, I'll sell. It's 165 at the end of the day. Now AT&T, I bought at 28, sold at 31.5, has an intrinsic value of 30.5, so I bought in at intrinsic value. I prefer to buy in below, but it wasn't going below until today, funnily enough. But I think they'll do well out of 5G, dividend aristocrat, and I think Donald Trump's rollout of Wi-Fi will help them as well with their streaming service. HBO Max hasn't been as good as they expected, but I think that could improve. Dividend yield of 6.76%, PE ratio of 13.8. I wouldn't count on dividend, but it's still there for the moment. Altria Group. Now I've sold most of my shares in this when it hit 41.5. I could go back in. I'm waiting for it to drop again. A dividend king. They have the best dividend yield, 8.18%, 13.8 PE ratio. Now I've done a video going through these guys, so I'm not going to spend too much time on them. They're an amazing one to go into. Arrow. Now these have been going above and below what I've paid for them. Frankly, I think they are very cheap. These are my way of hedging against the crash, because loads of people are saying there's going to be a crash. So what do? Do you do what one YouTuber's done, pull all his money out of the stock market? By his own admission, he's lost $40,000 to $80,000 worth of gains by doing that. And we know it's not about time in the market, as Jack Spencer says, it's time in the market. Now, and if you haven't seen the show, it's a great show. PE ratio of 3.7, dividend yield of 4.76%. Now, they engage in purchase, collection and servicing of non-performing loans. These do well when there's a crash, economic crash. Aviva, I've done a video on these. They're an insurance arm, and people expect these to do badly, but I think they'll do well. Dividend of 3.41%, PE ratio of 4.32%. I think they are undervalued. BP, these are to offset my tanker stocks. I think they're undervalued, and a PE ratio of 5.64, dividend yield of 10.16%. Now, I'm they have sold the North Sea assets to Premier Oil, and Premier Oil said to be upset about it because they overcharged Premier Oil for them. But so they got a good deal for it. Now, I'm in two minds. I was thinking BP are going to cut the dividend. It was the right thing to do because their dividend payout ratio is very high. Before all this started, the thing is they've sold their North Sea oil assets, so they may be doing that to pay for the dividend. And if they do, the share price will go up a little bit. If they don't, it will tank like Royal Dutch Shell. Either way, still low price. This is one I've done a video on. BT. They've gone up over 125, and I think they're struggling to get over that 125 mark. If they do, they can go as high as they want. They're the UK's biggest mobile operator at the moment since they took over EE. But people aren't seeing that. They're just seeing they spent a lot of money. They operate in Europe and UK. They are incredibly cheap. Anything below 180 to £2 a share is incredibly cheap for them. The P ratio of 5.54. They also maintain the internet for the UK. 13.08% dividend yield, which has been scrapped, but just for this year. Baidu, I did a video on that yesterday. They're the Chinese Google, just to show I put my money where the mouth is. I think there's huge potential in this. This has more growth than any other Chinese company. Now, don't get me wrong, Alibaba and Tencent, their health department alone is worth more than Baidu, but they've been dragged down by, they brought out their own version of Netflix and other things, and it's been costing them money. Once they start bringing in money for them, they'll be well suited. Bank of America, I've done a review on American banks in stocks, and Bank of America was one of the top two. P ratio of 8.59, dividend yield of 2.79%. It's actually below its price to book, which is what they're valued on. Barrick Gold is another recession-proof stock. I've done a video on gold stocks, and this was below its intrinsic value, below its price to book. It's high PE ratio, but I don't think that's fair. Dividend of 1.17. So if there's no crash, it pays me a dividend, and it should increase in growth. If there is a crash, it definitely will. Another anti-crash or recession-proof stock, CFVS Health. Now this is a perfect one because it's 11.89 PE ratio, 3.05% dividend yield, and this improves if there's although we don't want to see another wave, though we don't want to see a crash, recession due to another second wave, this improves in value if there is, purely because they do testing and their health side of it. This is one not a lot of people are talking about. I haven't seen anyone else talking about it. Card Factory. Now look at that. Whenever I've gone to Card Factory, there's always queues out the door. In the UK, it's the best place to go for cards. In the United Kingdom, I have so many of them. I've wanted to pick it up for a long time. 6% dividend yield. I don't expect to get that this year because they've been closed during the virus. 3 PE ratio. Now we go down. Profit margin for 2020, 11%. Debt to assets for 2020 first quarter, 61%. Now, this is ending 31st of January because they haven't had given guidance since then. Revenues increased 4%. Now, and what they've done is dividend per share decreased from 9 pence to 3 pence. So they cut the dividend yield to 6%. And to do that, they have actually, that's an incredible move, because the dividend was high in the first place, and everyone's cutting their dividend or scrapping it. They're keeping their dividend and using the money to keep themselves afloat, keep themselves going, not having to take out debt, and paying the bank loans, paying the interest on bank loans. And according to what they said, if they have any money left over, they will start paying down some of the debt. And to tell the truth, I'd rather that, because I'm going to be in it for quite a while, and I want to be in it until it reaches £3 a share, because this is a good one. I'm surprised no one else has done it. Cruisy doozy. Now, this is a semiconductor, and they do audio and voice signal chips. 80% of the customer is Apple, which is a bit nerve-wracking. They're a growth stock, so don't expect a dividend. High, a 22.25 PE ratio, which isn't high for the sector. Now, revenues increased in 2020, profit margin of 12.45, debt to assets 22.79. Now, how many young growth companies have a debt to assets like that, especially in this market? It's only that 80% customer being one person, and especially Apple. This is a mistake, Clovis Oncology. I held it too long, and getting rid of it. They keep on talking about a takeover deal, but that never comes. Coca-Cola, I'm sure you understand why. You know, it's one of the Goliaths of the beverage ones. 3.51%, 21.44. I've gone through it before, I won't go through it again. I went through the airlines. It came out with, and I've done an updated one of the airlines where Ryanair and Copa were the winners for the balance sheet, and purely because the restrictions put on some of the others. However, remember, those restrictions come with gains that Donald Trump is backing them, and if they get into financial problems, they will get a bailout. DocuSign, I've done a video about this. Basically, before all this started, I was being sent paperwork via DocuSign. It's not making a profit at the moment, but debt to assets is only 1%. This whole thing has brought the company on 10 years. It's grown at 10 years. They have leveraged a lot to get it to where it is. They have brought in so many customers, and honestly, it's one to look into. Electronic Arts. Now, this is one of the biggest one. You have Epic, you have so many players in this stream, and I'll be talking about one later. Electronic Arts, of course, does EA Sports, but 12.19%. 12.19 PE ratio, 55% profit margin, 33% debt to assets, and we know this time it's going to be. We know this time it's going to be used well. I waited until. I may have waited a bit long, but I waited until it was below the intrinsic value, and I got a buy signal. Now, ExxonMobil, this is price to book of 1.24. Again, to offset the tankers, has P ratio 18.64, dividend yield of 7.22%, and it's backed by Daddy Trump, profit margin of 6%, debt to assets is 47%. Now, I spoke about Fidelity Asian values. Now, this is the one, you guys are crazy. I spoke about foreign merger too, how it's a shell company, and how when it merges, it's going to be a company that's 2.2 times, worth 2.2 times the profit, expected profit. Of course, doesn't mean they're going to make that profit. They're going to be a new, like, Beyond Meat type company, vegan type company, and it's gone up 5% in a day. Now, I hope it keeps going. It looks a much more attractive proposition than Nikola, but I won't say any more on that. GW Pharmaceuticals, I'm down a bit on that. Not much, but they are the one medical MJ stock that is okayed across Europe and UK, as well as America. Genius Brands, I've done a video on that. Thought I'd dip my toe in it just in case it takes off, but as you can see, I'm not lost, but it's okay. It's just profit I took from AA and I put in there. Gilead, I did a video on that, said it's below intrinsic value, so I go in that and I'm up. As you can see, I went in at $73, and I considered $76 to be intrinsic value. Another analyst said $73.50, so I waited for it to hit $73. Glaxo, I've been swing trading this the last couple of weeks. I've been buying between $15.90 and $16.20, and then selling when it gets to $16.60, and been making quite a bit. And but Glaxo is just such a good company. It's below the intrinsic value. It's a PE ratio of 12, dividend of 4.9%, and they're doing the smart thing of not working on a vaccine. They're working on a vaccine booster, because any vaccine that comes in is going to need a booster. Grubhub, now you'll see a difference in the shares. It was 9.5k. I was heavily invested, and I've sold a lot of it purely because if the Just Eat deal doesn't go through, I was too heavily invested in it. I made a big profit. I pulled a lot of it out. Now, International Personal Finance is another recession-proof one. It has a PE of 2. That is crazy. 7.62% dividend yield. I'm not expecting that, but at the moment they are still paying. And again, it's another home credit segment, like credit cash loans, money transfer loans. Kraft Heinz is below its intrinsic value. It's below its price to book value, and it's owned by Warren Buffett, which that doesn't bother me. It's P ratio of 11.76, but dividend yield of 4.89%. I spoke about L3 Harris Technologies. They have a contract to make sure everything goes okay with the election. At the moment, I'm down 3% on that, but that's fine. It's nothing to worry about. Legal and General, I did a video on this. 7.47 P ratio, 7.54% dividend. Nothing to be sneezed at. Luckin Coffee. Now, this has been a roller coaster, up and down. Went in at 3.89. I've been swing trading this. I got out, it's pulled me back in. Apparently a German auditor has said they've gone through the books, everything seems fine. They've changed everything, and it's gone up on the German exchange. M&T Bank, it's another one. I did the banks, and it came out top. Also, this is one that Warren Buffett has been buying since the crash. PE ratio of 8, dividend yield of 4%, well undervalued. Marks and Spencers. Now, I've done a video on this. well undervalued. They paid too much for the Ocado deal, in my opinion, but they had to get a delivery sector. 4.96 PE ratio, 3.56 dividend yield. I went to Marks and Spencer's the other day. The food range is much more reasonable. I did a video on REITs and MPT came out tops. P ratio 24, dividend yield of 5.33%. Merck, the vaccine, they're under the intrinsic value. P ratio of 14, dividend yield of 3. Moderna, I've just left it there. I've sold off a huge amount of my position when it went up. I kept 2 just in case because it's now the house's money. Neo, now I sold when it skyrocketed, and then I bought back in at a different price. It's one of these companies that I did a video on car manufacturers, and Neo came in second above Tesla. And before you say crazy, it was on financials and fundamentals rather than whether the company's going to be a success. The one thing dragging it down is its debt, but it's coming up with a deal that should wipe out some of that, not all of it. Prudential Financial, I'm surprised more people aren't in this. Goes ex-dividend, so PE ratio of 6, dividend yield 6.69%. Now, when I bought in at $66, it was a price to book of 0.49. Now, even less, is Raytheon Technologies. I told you I'd be buying in under 70, 67, 79. I'll probably be picking up some more of that if it goes a bit low, 65, and then when it hits 60, and then 55, and so on. If it does that, I expect it to start going up. Red Row, spoke about how I would be picking up Red Row if it goes under 5, and it did. So 5.31 P, 4.2% dividend yield. Remark, I spoke about this. I sold it when it went up and it was there, and I bought back in at 2.4. So I made basically 40 cents a share, and I bought back in. They make, not only do they make the heat x-rays that the casinos have got, they have now got approval, FDA approval, for another aspect of their x-rays. So they've got facial recognition added to it, and they've got approval for that. Revolve, you remember I told you about Revolve? I bought in the same day that I did the video, and that's gone up a small percentage, but it's still gone up, which is good. This isn't just a retail company, online retail company, it's a data company as well. Serica Energy, which is just a small UK energy company. Well, it's not UK, but it's listed on UK. And Slack, I did a video on that, and we all know why Slack, if Zoom is needed, Slack will be needed. Simple as that. Taylor Wimpey, 7.55 PE, 2.54%. Uranium Energy, no offense, they've got a uranium mine in Texas, and this is one of these, such a low price, such a low investment. The government isn't going to let anything happen to them. And I've done a video how now is the time to try on risky stocks. Now this is one people don't understand. It has good fundamentals. Dividend yield of 15%. The profit margin has gone down, but has debt to assets of 45%. So it does the oil rigs. Now they deal with Saudi Arabia and Russia as well as America. This isn't in bankrupt. It wasn't even tipped to go bankrupt, but it was tipped that it might have to take out more debt or sell some of their rigs at a discount. and for some reason it keeps going down. It goes up and goes down, but because Robinhood investors have gone in this as well, look at the prices. Now I got 600% return on my money. A $20 investment went up to over $100. Sorry, £20 investment went up to £100. I took it out and bought back down at this price. So well, I see it is I'm playing with the house's money now, and the rest of it was profit. Now I got a couple of funds because to tell the truth, I bought them for my kids. I told you how for every like and every subscribe I got from that day, I will put £1 into my kids' account. I said to my kid, would you like the money in your bank account or would you like me to invest it for you? He said, do half and half. So thank you from my kid, not from my pocket. So I put them in here, they are staying there, and any dividends will get reinvested into there. Virgin Galactic, I've swing trade this. Now I sold it, I bought at 14, I sold when it went to 15.8, and I bought back at 15.3. Now waiter, now this is like a penny version of Grubhub. The only reason is there was certain rules why Grubhub couldn't take up why Uber couldn't take up Grubhub. No rules, they can't take up this for any reason, but at the same time the profit is bad, but it is with all of them in there. Debt to assets is 87%, which is high. I just think this is a company which could do well, and Grubhub are losing customers. This is the other reason why I pulled some of my money out. The risk to reward with Grubhub is getting too shaky at the moment. They're having legal actions. This is a company that is growing, and no offense, it's very cheap, but this isn't an endorsement. I told you before, I got into this the day before. I'm surprised this hasn't risen more. I got into this the day before Powell mentioned he was going to start the money printing machine, and he said he's going into these bonds, and there he is. Now the thing is, afraid we've run out of time, so I can't give another share reveal, but I'll try and do one later on. Okay, I hope you agree with me that rather than selling all your shares and coming out of the stock market altogether, you're better off insulating yourself from unstable stocks, taking profits and keeping the money to yourself. The problem with me is once I get out, they pull me back in. The queen of popular phrase. Nah, this isn't saying put all your money in stocks. I've always been an advocate of keeping a certain amount of money to the side, so that if there is another crash, you can still go and buy up shares. And I still believe that. I have money to the side in case. This isn't my only portfolio, by the way, so please bear that in mind. And all I'm saying is have a few crash-proof stocks there that will rise if there's a recession or a crash. I sold my Fizz shares in National Beverage Company. I feel I've done that a bit too early. There's been a lot of news reports coming out saying they've been flat. They're going to be flat, the earnings. I don't believe that, but I needed the money to do another deal. I made a huge profit from Fizz, needed the money for another deal, and here's what it is. I'm not as rich as like some people like Jeremy. I'm comfortable enough, but I have to move money about like all of us. So I hope I get a like and subscribe from you guys. If you've lasted this long, well done. And I will enter Fizz if it comes back down below my sell price. I do think there's a good future for it still. And I'll see you in the next video. Goodbye.